I have a target of 7,000 for the S&P, 23,000 for the Nasdaq, 55,000 for the Dow, and the hardest one for people to believe probably is that my target on the Russell, which had been 3,000, I've raised that to 3,300. I'm expecting a recession probably to start sometime this year. The melt up could be over this summer.
David Hunter returns to the show. He is the chief macro strategist of Contrarian Macro Advisors, and he's had over 50 years of experience working in the investment management industry. David was on the show last year calling for a market melt up. Well, he still thinks the market will melt up this year. And in fact, he's revised up his forecast for stocks. We'll find out exactly what he thinks is going to happen this year and next. And we'll be talking about the Federal Reserve. We're speaking right now ahead of the Fed meeting on May the 1st, Wednesday. So we don't know exactly what Jerome Powell is going to announce as of the time of this recording, but we'll talk about the Fed regardless. This episode is sponsored by NordVPN. And if you're new to the channel, make sure to subscribe and hit the like button and hit the bell buttons to stay up to date on daily finance and economics updates with experts in the industry. David, welcome back to the show. Always good to see you.
Hey, David. Great to see you again.
Great to see you. Let's just start with your call first that you made on my show last summer. You said that the stock markets will get a major melt up before we get a meltdown. And we can walk through your thesis again for the audience who hasn't seen that episode. You can click up here or in the link down below to revisit David's call from last year. But you said that we're going to get a melt up to potentially 6,000 to 7,000 points on the S&P 500. Now, we did get a sort of melt up. The S&P continued to rally. Like you said, we didn't hit 6,000 or 7,000 yet. So my first question is, are we still going to get that level? Is that still your call?
Yeah, that's definitely still my call. In fact, I've dropped the 6,000 part of that range, and I've back in January, and I raised my target to or had my target moved to 7,000. So I don't think I need that range anymore. I think my work shows that we are going to see the upper end of that range. So I have a target of 7,000 for the S&P, 23,000 for the Nasdaq, 55,000 for the Dow, and the hardest one for people to believe probably is that my target on the Russell, which had been 3,000, I've raised that to 3,300. So I think you're going to see this market once we come out of this small pause we've had for the last month, resume its upside, get actually steeper, and a run to the top from here will be broad, include small caps and large caps, include growth and value. I think it's going to be a historic run, let's put it that way.
Okay, well, David, just to recap recent price movements, it seems that this bull rally that the risk assets have had is starting to taper off. Stocks have seen new all-time highs. Bitcoin has seen new all-time highs, but all these risk assets have pulled back somewhat. So how would you evaluate the current state of market performance?
Yeah, I'd like to say markets stair step their way to the top. So you have to have these pauses along the way to rebuild the skepticism. Otherwise, markets get ahead of themselves, get overbought. So really, this market, it's been probably 4 or 6 weeks of sideways to down, more recently down movement. It's all within an uptrend. I don't see anything here that causes me concern. And actually, what I see is that wall of worry that helped carry us from 3,500 on the S&P back in October of 2022, all the way up to 5,250. The move down here to just a small move of maybe 6%, a little more, has rebuilt that wall of worry, and that's the fuel that fuels the upside. If you have skepticism, you have pent up demand.
We're going to continue with David's call on the markets, but first, a word from our sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more.
Are we going to get much lower prices, do you think, before we get that rebound to 7,000?
I think the odds are it's possible we could get down to 4,800. I think that's unlikely, which isn't all that far from where we bottomed out last week. I think more likely that low of last week holds. And today, who knows? You get volatility out of Fed meetings, so who knows what today brings? Could go down to 5,000 or may not. But I think this is the end of that consolidation, and within hours or days, I think we resume the upside. So I don't look for a lot of downside here. If we do happen to break the lows of last week, like I said, at 4,700 is, I think, the 200-day moving average that could come into play. I'm not expecting that. I think when I look at the internals and look at the nervousness out there, I think more likely we're going into this meeting very skeptical. People are nervous and getting more nervous that Fed hikes are done, and the Fed's got to worry about inflation coming back the other way, breaking out again. So I think people are going into this with pretty big amount of skepticism about a bull market, and that to me is going to temper any downside. And I think Powell, my guess is that Powell's going to not come out all that hawkish. He'll continue to say higher for longer, I would guess. But I think they're going to have to temper that with the idea that there are signs, certainly saw it this morning in some of the numbers, and recently, there are signs that the consumer is slowing down, that the economy is slowing down. So we had that kind of strength in the first quarter, but obviously the GDP number recently was unexpectedly low, and numbers in the ISM numbers and Chicago purchasing managers yesterday, all those things are coming out, indicating we're in a slowdown. This economy is getting weaker. So the Fed has to look at both the economy and inflation. I don't think they can get much more hawkish here. I think they have to worry that they are going to tip this thing into a recession if they're not careful.
So what do you think they're going to prioritize, inflation or unemployment?
I think he'll still come out saying, the risks are somewhat balanced. They'll probably prioritize inflation a little bit, given, the comments of the last month. I would guess that most of the Fed members want to make sure that we don't let inflation heat up again. However, like I said, the numbers of late have to be causing them some concern that, things are getting weaker here and we can't go too far. And they understand, they may not fully understand, but they understand there are leads and lags to their policy. And if they go too far, they aren't going to be able to reverse that quickly.
Let's talk about market expectations for what the Fed's going to do. I'm looking at the CME Fed Watch tool, and again, this may change in a couple hours when the FOMC comes out with their decision and we hear from Jerome Powell. But I'm looking at a 40% chance of a cut by September. That's the first significant probability of a cut this year. I'm not seeing any probability of a hike. What's your take? When are we getting a cut?
Yeah, I really don't worry. I don't play that game of how many cuts are we going to get this year and when. Um, they will happen. I'm pretty sure we'll see some cutting this year. I'm not in the camp that says there will be no cuts. And I also think what we've seen here in the last 2 or 3 months, particularly the last 2 months, is because inflation came in above expectations, particularly CPI, but other numbers too. And because the Fed is starting to worry that things are going to go the other way. Commodity prices have picked up some things like that. Oil prices were up. Obviously, the expectations for rate cuts lessened, and they got pushed out. You could just as easily in the next next couple months, get numbers going the other way, and see those expectations come right back the other way. So I think people misunderstand that what the Fed thinks today is not necessarily what the Fed's going to think tomorrow and or next month. And what we see in the bond market is a reflection of expectations today. Those bond market expectations can change on a dime, and I actually think the likelihood is that sometime in the second quarter, we're going to start seeing it go the other way, and maybe some of those economic numbers of the last few days will be part of that. Is the beginning of that.
So let's revisit your melt up call once more. What is your overall thesis here? Are you betting on a recovery of the economy? Are you betting on more Fed liquidity? What's going to drive prices up to $7,000 points on the S&P?
Yeah, let me put it this way. I think the narrative that will drive it will be that rates are coming back down. I think this has been a correction in rates. Don't forget, rates were at 5%. And back in early November, gapped down and started to move down to 380. So they dropped 120 basis points. We've had this backup in rates, but I think it's only a correction in that downward trend. So even though it backed up quite a bit, my guess is that downward trend resumes. So I expect rates over the course of this year to get down under 3% on the 10-year. So part of the melt up will be lower rates. I think we will get back to recognizing that inflation is trending down and moving towards that 2% target. So that will be received bullishly. I think you will see earnings look like they're turning up. So you're going to see increased earnings expectations over the course of the next 6 months, and estimates for next year starting to be hiked. And I think you're going to see, as this market comes out of this consolidation and investors realize they're not going to get that lower entry point that they were hoping for, because you've heard the calls out there, people are looking for 10 or 15% pullback at least. And so they're thinking, yes, I missed the bull market. Yes, I missed the run from last October. Yes, I believe the market can go higher, but I'm not coming in here. I'm going to come in 10 or 15% lower. When this thing reverses, like I said, could reverse today or tomorrow. When this thing reverses, and I emphasize could, I don't know when it'll reverse, but I think it's very soon. When it reverses, you're going to see a lot of those people on the sidelines who have fought this market all the way up saying, I got to get in now. I can't wait for more pullback. And so you'll get FOMO kicking in. There's a lot of skepticism out there. People didn't believe the market when it moved from 3,500 to 4,600. Then when it went back to 4,100 last October, they didn't jump on there. They only jumped on and began to jump on when it got to new highs. And a lot of them said, okay, it's new highs. Maybe it is a bull market. But like I said, they're saying, I'm not jumping in here. I'm going to wait for a pullback. They're thinking this is going to be a deeper correction. When it doesn't turn out that it's deeper, they're going to be forced to have to buy on the upside. So that means FOMO.
7,000 on the S&P is 40% higher than today's level, which is 5,000. Are you expecting a slow grind up to 40% higher from today, David, which would take months, if not years? Or are you expecting a catalyst from either a political, geopolitical event or a macro shock that will send prices much higher in a very short amount of time?
Yeah, the answer is I do expect it to be relatively fast. So I think as I said, this may be the last leg coming out of this correction, this 6 or 7% correction. This may be the last leg. So from, let's say it turns at 5,000, I think you could run this from 5,000 to 7,000 by this summer. So it'll be very steep. And I believe it will be. The second part of your question again was, no, yeah, geopolitical. I don't believe it's geopolitical. I don't think those events are going to be what drives it. I don't believe it's really any major macro event out there. It's really the recognition that the Fed's done tightening, that at some point here in the not too distant future, they're going to start easing or cutting rates. And that means we have a pretty long runway ahead in terms of not just what's happening second half of this year, but what's happening next year and the year after in terms of an upswing in earnings and an upswing in the economy. So if the inflation calms down, if interest rates start rolling over again, then I think you're going to have people say, "What am I on the sidelines for? I've got to get in." So it's really driven by people having to change from that bearishness they've had for the last 2 years and skepticism they've had to getting on board because they'll see it as a new cycle.
Well, that's the critical assumption here, isn't it? That inflation comes down and the Fed lowers rates. Why is inflation coming down?
Well, first of all, look at oil, and I've been a bear on oil, so and pretty much the only bear on oil for quite some time. When it was 130 back in 2022, I said it could go to 85, and then when it got down there, I said it could go to the low 60s. I still believe that's where we're headed. This most recent run up where WTI crude went up to, the mid to high 80s. Everybody was calling for 100 again and saying, what are you, crazy? You think oil's going down in this environment? Well, oil's down at 80 and it looks like it's heavy and heading lower. I think you're going to see this year $60 oil. And so that will help. I mean, it's, gasoline prices will follow oil. So gasoline prices, which have been up strongly the last 6 months, are going to roll over. I think you're going to find some of the things that spiked, like cocoa and cotton and some of those things that got people's attention because they were up, they're rolling over. Orange juice rolled over. The grains, if you look at the grains, they're heavy. They look more deflationary than inflationary. I think the most recent rise in rates is going to, at some point here, temper housing. It has in some places already. You're seeing home prices break in some of the western cities. So there's all of that. As I said, the consumer of late is showing weakness. I mean, look at Starbucks today. They came out way below expectations in terms of their quarterly stuff. So you're starting to see a sign that, and I've talked about a have and have not economy for quite some time. You're seeing signs that the have not part of the economy, which is pretty much the middle class on down, are really having trouble. They don't have a lot of discretionary income. So, and I think delinquencies on credit cards are another sign that there are signs out there that the consumer is getting stretched.
Right. So that was actually my next question. What if we tip into a recession? What if the consumer gets overstretched and businesses start to actually see earnings deteriorate, not improve? Are you still going to stick to that melt up call, or would you revise?
Well, let's put it this way. The melt up could be over by the time, I'm expecting a recession probably to start sometime this year. the melt up could be over this summer. And you're not going to really know. I mean, the economy still looks like, yes, it's slowing, but it's not, you're going to still have a soft landing scenario out there for at least the next few months. Things aren't going to roll over hard here. They will roll over hard later, but I don't think it's going to change the narrative in the short run. I mean, it was just weeks ago. People were so sure we weren't, we went from soft landing to no landing. And then that GDP number came out and kind of caused people to step back a bit.
You don't think that the stock markets tend to lead economic activity? Meaning, if we get a melt up, doesn't that mean that the markets or investors at least are expecting economic growth, not a recession?
Well, keep in mind, I'm calling for a big bear market to fall and melt up, and I'm calling for a global bust next year, which could even start before the end of this year. But there are periods of time where the market will be looking at the here and now. And so you can have a final run up into a secular top, even though within 6 months you're heading south.
I want to come back to this meltdown after we get a melt up in just a bit. But let's revisit some other asset classes first. You mentioned the Russell, which is small caps and mid caps. That's interesting because the Russell's been trading range bound since I think 2022, and it has been lagging the large caps. If you think that's going to go up, then your thesis is not just a few big companies pulling up the S&P or the Nasdaq. You think the entire market is going to get a melt up.
Yeah, I think, as I said, and I've said this for a while, I normally when you're and this is a run into a secular top that I believe the secular bull market started in 1982, August of 1982. So this is the culmination of a 41 going on 42-year secular bull market. Normally, if you're going into that kind of a top, markets narrow into the top, right? So normally you would see a market get ever more narrow as it did, going back to early this year, people were saying, oh, this is just the Mag 7, this is a very narrow market. It's not good quality. And I fought that and said, actually, if you look below the surface, you're getting some broadening of the market. And that's continued into this period now. So it's an unusual thing to have it broaden into a secular top, but that's exactly what I expect. You will have, if rates are coming down, and yet people are seeing signs that the cycle, the Fed may end tightening, and they can start looking over the trough to the next cycle. They'll start buying cyclicals, which they have already done. They've started that. So you'll see cyclicals running. You'll see value stocks running. You'll see growth running. Rates will be coming down, so you'll get that benefit in dividend stocks, et cetera. And you'll have growth stocks running because rates are coming down. So I think you can have a broadening of the market into the top, surprisingly.
Okay, so can you break that down even further? So growth stocks and some value stocks running. Which sectors are we talking about here?
Yeah, I think some of the areas that will do the best. I mean, we've seen recently copper waking up. So I think in the cyclical/value area, I think you'll see copper producers and other. I actually think steel, although it's been weak this week or the last couple of weeks, I think steel will do well. I think you'll see some of the laggards like autos and airlines and things like that will have a catch-up rally. Home builders, which have been very strong for the last year and a half, I think will continue that strength for a while longer. They look like they've got more legs, so the home builders will continue to do well. Now, at the same time, you've got those cyclicals doing well. And by the way, XLI, which is the industrial ETF, that thing has been very strong for quite some time. It was one of the things I used to push back against, the market being only the Mag 7. You look at the Ingersoll Rands and the Cats of the world and the Packards of the world, Cummins engines, Eaton, that sector has been strong, and I think that strength will continue. In the tech on the tech side, on the growth side, I think the Amazons of the world, the Mag 7s, I think will Some of them been hit and they will come back, and some that are showing some strength, like Amazon today came out with their earnings. I think you'll see that continue with more strength. Semiconductors, which I've been on since the beginning of this move way back in 2022, highlighted them as a leading sector. I think that will continue. I've got a target on SMH of 300. So you've got 50% upside there. So there's a broad array, even things like biotech, which has been really flat on its back for a long while and hasn't been much of a participant. I think even that, if rates start coming down, will start catching up.
During this melt up, should we stay away from defensives like consumer staples, utilities?
Yeah, I think they will be the laggards. They'll probably rally, because if you're going to have a 40-50% rally in the market, they will participate, but they'll be the laggards that underperform the market. And so I think utilities, the healthcare area, maybe, certainly staples, those areas I would probably say are the ones that are going to underperform. And the one that I think probably is going to underperform maybe the most is energy. I think the XLE ETF, I think, is potentially going to be going down while the market's going up.
What about other asset classes? Let's talk about gold. So gold has had a huge run up. Where does gold fit into your picture of this melt up and then a meltdown?
Yeah, I've been a huge gold and silver bull here, and I think it's just beginning. So gold, my target on gold has been for quite some time 3,000, and I think that's a conservative estimate of where it goes pre-bust. So my targets, when I put out a target, I'm saying pre-bust. So I think gold can go to 20,000 by the end of the decade, for reasons we can go into when we talk about the bust. But pre-bust, I think gold can go to 3,000. Silver, I have a target of 60, and I've been saying of late that I think if it gets through 60, you could see 75 very quickly. So 60 to 75 is kind of where I see silver going this year. So those are big moves. And the miners, which have lagged, and they've had to move out of their bottoms of a few months ago, but they've lagged. I think they have huge upside from here.
Why would gold go up in an environment when all other risk assets are going up? I mean, presumably if you have things like the S&P going up 50% or 40%, according to your call, then capital needs to flow into those risk assets. Capital wouldn't be flowing into safe haven assets like gold, right?
Yeah, it's interesting, because I think people have a recency bias where they assume that the precious metals have to move opposite of the market, the equity markets, and yet go back to the first decade of this century, 2001 to 2011, you had a bull market in stocks during a good part of that, and you had a very big bull market in precious metals. So there are times when they move together, and I certainly think this is one of those times. Technically, they look very strong. Gold obviously has moved to all-time highs, so there's no resistance above it. Silver's got a lot of resistance to move through, but I think it's a very thin area that once institutions decide that they need some of that because the momentum is there, you will see that the prices can move dramatically in pretty quick fashion.
Okay. Well, Bitcoin is
and by the way, let me answer with
sure.
in terms of the metals. I think rates coming down, and probably the biggest part of it that has not manifested yet, but I think will, is the dollar coming down. I have a dollar target of 80. So
80, okay.
So if the dollar's at 106 and I have a target of 80, imagine what that does to metals if I'm anywhere near correct.
Well, the dollar has been strong, so that is quite a contrarian call. Can you elaborate on that? Why is the dollar coming down? Are you expecting other central banks to be more hawkish?
No, I think what it's going to be, not so much hawkish, but I think, and again, this is a contrarian call, but I think we're going to find that the Fed's going to have to scramble and reverse themselves here. and I think the others are going to be slower to do it. So ECB and Bank of Japan obviously is going to be going the other way. They've got issues here that I think are going to come to the forefront here very quickly, where their currency is going down. I mean, their currency is going down. Their rates are about to break out, and they've got a very leveraged balance sheet. So I think you're going to see. I think there is a potential. This is not a forecast, but when I look at the currencies and see what's going on, it strikes me there's a potential here for some sort of an accord. Plaza Accord of 1985. I'm not sure it'll be that, but something where they coordinate the valuations of the currencies, particularly the yen versus the dollar, because Japan can't withstand much more pressure.
Okay. What's going to happen to the 10-year yield? Is it going to retrace 5%? Currently at
Yeah,
4.65?
The 10-year gap down last November from 480. So there's a small gap there at 480, and we're not very far from it. So it could, here in the next couple of days, fill that gap. Other than that, I don't think it's going very far to the upside. I am not in the camp that says we're going to go back to 5% or higher. Obviously we could, but I think 480 is kind of possible, and then I think we roll again. And I'm, as I said before, I'm looking for sub 3% here in the next 6 months, and it could be 2.5%. We could go as low as that. So for that to happen, some of my other call has to manifest itself, meaning slowing economy, starting to look troublesome, inflation rolling over. We find out that the first quarter numbers, the first 3 months of inflation were more of a counter trend move, and that we go back to the downtrend. If those things come to the forefront, I think you're going to see bonds do very well.
Before we get the meltdown, then bonds will still perform well?
Yeah, I think bonds go from here to 250, let's say, on the 10-year, maybe sub 3 on the 30-year. Obviously shorter rates will come down. And then, it's possible from there we get a counter trend move back up. They're not going to go straight down. So you could see 2.5, let's say, back to 3.5.
The recent trend for the 10-year has been up. Something has to happen for that to reverse course, right? What's that catalyst, do you think?
Well, again, trend is short-term trend. Yes, it has been up, but don't forget we were at 5%, went to 380. So what we're dealing with here, in my opinion, is a counter trend, not the main trend. So if it rolls over, it resumes the main trend, which takes it sub 3, maybe to 2.5. Then we get another counter trend from 2.5, maybe back to 3.5 during a period where, why do we get that? We could get that because the Fed looks at the market at 7,000 or somewhere between 6 and 7,000 and says, my God, animal spirits have broken out. We got commodities running. We got to tighten. So they could, even though they begin easing, and I don't know whether that means rate cuts or, no more QT or what have you, but they could then reverse themselves back right on the eve of a global bust because they're so worried about the market breaking out, and tighten at the very wrong time, the exact wrong time. So you could get a counter trend move in rates back up, not all the way back to here, but back up 100 basis points. But I'm not so worried about that. Let's get to the 2.5 first and see where it goes. And then if we get that counter trend from there, or even if we don't, from there during the global bust, I'm calling for the 10-year down to 0 or below and short rates to negative territory. So I do think there is one lower low in rates coming next year during a global bust.
Bitcoin, then, how do you see Bitcoin fitting into this picture? I'm guessing you think Bitcoin is also going to melt up alongside stocks.
Fortunately, I don't have to make that call because I have begged off of Bitcoin from the very beginning. I've said I just don't follow it. So
all right.
I think it's a tough call. If I were following it today, I think it's a tough call which way Bitcoin goes from here, because it does look. I could make the case either way, but I don't follow closely enough to be somebody to listen to about that.
Fair enough. Let's talk about this global deflationary bust. What is that? What are we referring to exactly?
Yeah, so there's shorter term policy and longer term policy implications. I think basically my thesis for a global bust is that we have leverage in the system so much higher than it's ever been before, and we're heading for a downturn. So, I think when I say leverage higher than ever before, we've got 320 trillion in global debt, right? Both private and public. We've got quadrillions in notional value of derivatives, which is leverage on the markets. So, even looking in comparison to 2008-9, we are so far beyond anything we've ever seen before. Leverage works well on the way up, right? It helps enhance returns. On the way down, it really exacerbates problems. So first and foremost, the reason for a bust is that leverage can turn a normal downturn into something far worse. We saw that in 2008-9 in spades. The leverage in our banking system was why we had a financial crisis like we've never had. This time, you've got leverage far beyond that. Our banks, particularly our large banks, are in better shape because of 2008-9, but European banks are in trouble. The Canadian banks didn't learn our lesson. They were in good shape back in 2008-9. Their system is very leveraged today. Australia's leveraged. China's got problems, obviously. Japan's very leveraged. So I think the problems could come, the catalyst could come from overseas, but it's going to be global. We'll be a part of it. And the other piece to this, if I put a formula together, it's leverage plus fragility caused by the pandemic. I think under the surface, we still have a lot of imbalances caused by what happened in the 2020 to 22 area. Yes, we've recovered statistically. Yes, lots of areas have done well, but lots of small businesses failed and lots of others are hanging on by a thread. It created, because of the response, the 5 trillion in QE and all the debt we put out to deal with the pandemic. It's caused a very fragile system. We've got I'm talking about the US, but it really is around the world. There's more fragility in the system going into what I think will be a recession this time around. And that just will exacerbate it'll be a global recession. I think the problems, the imbalances are around the world. We're not unique in that. And then thirdly, so I go leverage plus economic fragility from caused by the pandemic, plus what I think will be a very big policy error on the part of central banks. So the central banks in my opinion, don't really understand the underlying risks. They're not thinking they wouldn't be doing what they're doing now if they understood how fast this thing can go from looking fine to disaster. The leverage will take this thing down fast. We saw it in 2008. I remember in 2008, in early September of 2008, I remember I was one of the only voices out there saying, we're heading for a hard landing. And I got a lot of pushback because every economist out there was saying soft landing, no recession in sight. 3 weeks later, we had Lehman Brothers and a huge financial crisis. So that's how fast things can come, look okay, and then turn around and go south. And I think that's what we're going to see. Leverage will do that again.
When you say deflation, are you referring to deflation in asset prices or deflation in CPI, consumer prices?
Yeah, I think we'll actually see overall deflation. It won't last long. It's not a depression. It's not a long drawn out. But I think technically, even our price indexes will be in deflation. So it'll be asset prices for sure. I'm calling for an 80% bear market, or the potential of an 80% bear market from the top. But it's more than just asset prices. I think you'll see commodity prices fall through the floor. My oil target in the bust is $30. So that gives you some idea. I think we're going to see commodities get hit hard. Copper could go from, I have a copper target for pre-bust, meaning this year, of $6. And I had that when copper was 3.25, or 6 months ago. I have a copper. I think copper could go to as low as $1 in the bust. So you're going to have some big moves in commodities. You're going to have other prices coming down across the board. So, but I think any deflation lasts not more than a year.
When you say that this is not going to be a depression, I wonder why you think that is. These problems that you've highlighted are long-term structural problems that if they do manifest in some sort of sharp economic downturn, it sounds to me like it might last a while, right? But it won't?
Good question. It won't, for one reason, and that is the printing press. They will. We saw what they did in 2020, right? We saw what they did in 2008-9. And the period after that with QE 1, 2, and 3. What I think you're going to have when I say bust, I should define bust because people use terms without really understanding what they mean. I've started to talk about bust many years ago before it was being used. Global bust to me is something sort of like 2008-9, except it goes farther. In 2008-9, we were on the verge of a bust when GE was about to go under because the commercial paper market was frozen. If you remember that, in the fall of 2008, the commercial paper market froze up, and fortunately, the government responded very quickly, and that was right after Lehman, and responded with a lot of money, and so we avoided the bust. We avoided that stage that would take us over the cliff. We got very close, but we didn't get there. This time, I think we go over that cliff. And the reason is because of 2008-9 and because of 2020, our central bankers are all telling us they won't do that again, right? They're all saying, we don't want to go back there. We know it was a mistake. We're not going to print money like that again. That's nice to say, until you're staring it in the face and you've got banks across the globe dominoing across the globe in failure. They can't sit there and say, well, but we don't want to cause inflation, so we're not going to print money, or we don't want to prop this up. They will come in. And my estimate is that what it will take this time around, it took $5 trillion in 2020, or at least that's what they did. This time around, I think you'll see the Fed balance sheet expand by 20 trillion. So you'll go from 9 or 10 trillion to 30 trillion. And you'll see proportionally like amounts coming from every central bank.
That's going to spark massive inflation, would it not?
With a lag, because they're dealing with deflation and financial crisis, of major proportions. It will take a couple years for that to manifest in terms of inflation starting to break out. You'll go from negative inflation in 2025, maybe into the first half of the following year. It'll be low single digits. By the end of 26 and into 27, inflation is going to move in high single digits toward double digit. By the end of the decade, I think we'll be looking at 25% inflation in this country. So yes, it's going to manifest in a huge commodity cycle, a huge inflation cycle. I'm calling for $500 oil by the end of the decade. Like I said, gold 20,000, copper will go through the roof. You're going to cause a real collision between this massive money and no infrastructure to deal with all the money chasing fewer goods.
By the way, this financial crisis that you're speaking of down the line, well, we're getting sort of a renewed fear of a financial crisis now in the U.S. with the Republic First Bank recently shut down by regulators. People are commenting that hundreds of small regional banks across the U.S. are feeling stressed. This came in from an article from CNBC. Christopher Wolf, managing director of Fitch Ratings, told CNBC that you could see some banks either fail or at least, dip below their minimum capital requirements. It seems to me like even the people at the top are believing that this is not the end of bank failures. Where do you stand on this?
Yeah, I agree with that. I think in the bust, which is mostly next year, like I said, it could start before the end of this year. Who knows? Because we will start with an economy in recession, right? It'll look like a recession, and then morph into a bust as the financial system starts breaking. So I think we'll see recession before the end of this year. Whether the bust hits before the end of the year or not, we'll see. Yes, I think there's major bank failures going to happen. Like I said, in terms of the big banks, our big banks are in better capital shape than they've been. They were forced to get religion at the back in the 2008-9 GFC. However, there's so much counterparty risk out there, and if we see major banks failing around the globe, it's going to come back to us. So I can't say our big banks are immune. Certainly, our regional banks are very vulnerable. We saw that a year ago, and like you said, there's some signs, and that's why it's important to remember this stuff doesn't happen overnight. You don't go from everything healthy to everything breaking. There's things under the surface that are moving in that direction already. It just doesn't all happen in a time frame that everybody expects. So I think by the end of the year, I think some of those problems, we've got obviously commercial real estate problems in those regional banks. There's a lot of things under the surface, but that does not prevent a melt up before we get there.
That was a very thorough discussion of pretty much all asset classes that I can think of for the moment. We didn't cover real estate, but we can go into that next time in more detail. Thank you very much for your analysis. Where can we learn more from you and read more of your work?
Sure. Yeah, I'm on Twitter pretty much every day. So my handle there is at Dave H. Contrarian, not David, but at Dave H. Contrarian. And I also put out a quarterly letter that's by subscription. I always tell people if they have interest or think they might have interest in it, there's a cost to it. So if you want the details on the letter, direct message me on Twitter. So just click that little envelope in the box and message me, and I'll provide details.
Yeah, you have a lively Twitter thread, so I encourage people to go check that out and follow you and read more of your work. So we'll put the links in the description down below, and of course, check out Dave's newsletter as well. So thank you very much. I'll speak to you again soon.
Okay, thanks, David.
And thank you for watching. Don't forget to like and subscribe.